Happy Monday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Monday, January 6th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the pending barrage of data support or refute key macro themes? Our answers are, after a couple of holiday shortened weeks, the upcoming week features the first full slate of economic and policy data in a while. How asset markets respond to these catalysts may provide signals for how they are likely to trade throughout the first quarter or two of 2025. Given the asymmetry that still exists in the positioning cycle, i.e., investors are crowded on the bullish side of the boat, investors should expect any data that threatens the legacy themes associated with all that bullish positioning or introduces new bearish themes will cause problems for asset markets. The first batch of data came in the form of December services and composite PMIs, which generally indicate a modestly improving global economy, with the US, Japan, and India outperforming, and Europe and Canada lagging. One bearish theme that may continue to develop is our triple S's theme, which highlights the risk to asset markets from the size, sequence, and scope of fiscal and regulatory policy changes in the USA. Today, investors received a positive development on that front, as the Washington Post reported, aides to President Trump are considering a tariff plan that will be narrower than the universal 10 to 20% tariffs he threatened on the campaign trail. The new plan would apply to all countries, but be limited to specific imports critical to the U.S. economic and national security. The U.S. dollar is down nearly 8% today on the news, its largest one-day decline since early August. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with the question from our community. This one's regarding market to price in deflation via China. Question reads, any thoughts on the market pricing in a deflation market regime in the coming months, given the slowing in China and a decoupling of Chinese rates from the rest of the world? Does USA, Europe, and Japan eventually catch up to the direction of the Chinese economy and asset markets, or where the direction of Chinese economy and asset markets are going? I'll just unpack that kind of in succession. So any thoughts on the market pricing and deflation given the slowing in China? So I'll start by saying, China's slowing, but it's not really, it's meandering lower. It's not like this big sharp slowdown that investors need to be, frightened out or freaked out about. The worst, we've probably seen the worst of the Chinese economic situation for the time being, given that we've got the rhetorical policy pivot in support of both greater monetary or sort of more dovish monetary policy and greater fiscal policy support for the Chinese economy in recent months. We've gotten those indications from the Politburo meeting. We also got that from the Central Economic Works Conference as well over the past couple of months. So, we're probably going to see more stimulus in China, both in the form of monetary stimulus and fiscal stimulus. So it's very unlikely that China's weak economy gets weaker to a significant degree in the coming months. So that's positive at the margins as it relates to kind of potentially staving off a deflation market regime. Now, the thing that I think would cause a deflation market regime as it relates to China is a potential devaluation of the Chinese yuan. I recall that we saw the Chinese yuan get devalued, to a double-digit degree in 2018 and 2019 as China was offsetting the advent of new U.S. tariffs. We also saw that in 2015, 2016 as China was slowing down pretty tremendously, and the sort of global trade was really starting to slow significantly back then as well. So this is, we have a playbook for this. China devalues the yuan, the rest of the world's currencies tend to get devalued, and ultimately we see that kind of come home to roost in asset markets in the form of negative risk asset performance. So that's something that is a risk, especially if we do see aggressive tariffs on China. But again, now the Washington Post are reporting that quote unquote aides close to President Trump are reviewing a plan. It doesn't mean that this will be the plan, but obviously the global currency markets are tuned in on this, and they're very hypersensitive to this, as evidenced by the near 1% decline in the dollar today. This is something that will have significant impact as it relates to the outlook for the global currency market, because again, more tariffs tend to lead to more dollar strength, because the currencies, the countries that are on the other side of those tariffs tend to devalue their currencies to offset the incremental tariffs. And so that's something investors need to be aware of, and that could cause a deflation market regime. And then finally, with respect to the end of the question, does the U.S., Europe, and Japan eventually have to catch up or down to where China is? And my answer to that is unequivocally no. China is not the engine of global growth that it used to be, maybe 10, 15 years ago. And that be as a function of that, you shouldn't be expecting dispersion across economies and asset markets, as opposed to, what used to be the case, which is, China being very dominant as it was in the early 2000s and even in the early aughts as well. That was more anomalous relative to longer term economic history, where we have seen much more divergence and dispersion in economic performance and asset market performance. And so this sort of regime of dispersion that we've been in for a while, in our opinion, is likely to persist, with U.S. exceptionalism kind of remaining dominant, at least for the first half of the year. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, January 6th, 2025. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.